Ever wondered how some investors seem to make money regardless of the market's ups and downs? It's like they have a secret weapon, a way to profit whether stocks are soaring or plummeting. This isn't magic, folks, it's the power of option trading. Options, often perceived as complex and risky, can be your ticket to a whole new level of market engagement. But don't worry, we're here to break it down for you, step by step. Imagine a world where you can control large amounts of stock with a fraction of the capital. Picture yourself profiting from market volatility, turning uncertainty into opportunity. That's the potential that options offer. We're not talking about get-rich-quick schemes, but a calculated approach to enhance your investment strategy. With the right knowledge and a healthy dose of caution, options can become a valuable tool in your financial arsenal. This is not about gambling. It's about understanding the mechanics of a sophisticated financial instrument. It's about learning how to leverage your positions, manage risk, and potentially generate profits in various market conditions. So, buckle up, because we're about to embark on an exciting journey into the world of option trading. Get ready to unlock a new dimension of market possibilities. This is where the real action is, folks. Options are not for the faint of heart, but they can be incredibly rewarding if you know what you're doing. It's time to ditch the sidelines and step into the arena, where you can actively participate in the market's movements. Are you ready to take control? Let's dive in. Before we jump into the exciting world of calls and puts, let's lay the groundwork with some basic concepts. Options, in essence, are contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, strike price, within a specific time frame, expiration date. Think of it like having a rain check for a stock. Now here's where the magic happens. You don't need to own the underlying asset to trade options. You're essentially betting on the future price movement of that asset. If your prediction is correct, you can exercise your option and buy or sell the asset at the strike price, pocketing the difference as profit. But if you're wrong, you can simply let the option expire, limiting your loss to the premium you paid for the contract. There are two main players in the options game: buyers and sellers. Buyers, also known as holders, are the ones who purchase the right to buy or sell. Sellers, also known as writers, are the ones who sell those rights. Each side has its own set of risks and rewards. Buyers have limited risk but unlimited profit potential, while sellers have limited profit potential but unlimited risk. Understanding this fundamental difference between buying and selling options is crucial. It's like choosing your side in a tug of war. Buyers are betting on the price swing, while sellers are betting on stability. Both strategies have their place, and the choice depends on your risk tolerance and market outlook. Now that we've got the basics down, let's talk about the two main types of options: calls and puts. These are your directional bets, allowing you to capitalize on both upward and downward market movements. A call option gives you the right to buy an asset at the strike price, while a put option gives you the right to sell an asset at the strike price. Think of calls as bullish bets. If you believe a stock is going up, you'd buy a call option. Let's say you buy a call option for Apple stock with a strike price of $150. If Apple's price rises to $160 before the option expires, you can exercise your option, buy the stock at $150, and immediately sell it for $160, making a tidy profit. Puts, on the other hand, are your bearish bets. If you think a stock is headed south, you'd buy a put option. Let's say you buy a put option for Tesla stock with a strike price of $200. If Tesla's price drops to $180 before the option expires, you can exercise your option, sell the stock at $200, and then buy it back at $180, pocketing the difference. Remember, you don't have to exercise your options. If the market moves against your prediction, you can simply let the option expire. Your maximum loss is limited to the premium you paid for the option. This flexibility is what makes options so attractive, allowing you to manage risk while participating in market movements. One of the most alluring aspects of option trading is leverage. With options, you can control a large number of shares with a relatively small amount of capital. This magnifying effect can amplify your profits, but it also increases your potential losses. It's a double-edged sword that demands careful consideration. Imagine you're bullish on Amazon stock, currently trading at $100 per share. Instead of buying 100 shares outright for $10,000, you could buy call options for a fraction of the cost. Let's say each call option controls 100 shares and costs $10. You could buy 10 call options for $1,000, giving you control over 1,000 shares. Now, if Amazon's price jumps to $110, your 1,000 shares would be worth $110,000. After exercising your options and selling the shares, you'd pocket a profit of $10,000, a 100% return on your initial $1,000 investment. This is the power of leverage at play. However, the flip side is equally important. If Amazon's price drops to $90, your options would expire worthless, and you'd lose your entire $1,000 investment. This highlights the importance of risk management and understanding the potential downsides of leverage. Section 5. Time decay, the ticking clock of option value. Time is a crucial factor in option trading. As an option approaches its expiration date, its value gradually erodes. This phenomenon, known as time decay, works against option buyers and in favor of option sellers. It's like a ticking clock that constantly influences the value of your options. Think of it like an ice cube melting. The closer you get to the expiration date, the faster the ice cube melts. Similarly, the value of an option decays more rapidly as it nears expiration. This is because the probability of the option becoming profitable diminishes with time. For option buyers, time decay is a risk factor. They need the underlying asset to move in their favor quickly enough to offset the erosion of value. Option sellers, on the other hand, benefit from time decay. They're essentially betting that the underlying asset won't move significantly before the option expires, allowing them to collect the premium as profit. Understanding time decay is essential for both buyers and sellers. It influences your trading decisions, affecting the timing of your entries and exits. It's a constant force that you need to be aware of as you navigate the options market. Section 6. Risk management, protecting your capital. Now, let's talk about the elephant in the room. Risk management. Options trading can be incredibly rewarding, but it's not without its risks. It's crucial to have a solid risk management plan in place to protect your capital and avoid costly mistakes. This is not about eliminating risk altogether, but about managing it intelligently. One of the most important aspects of risk management is position sizing. Don't put all your eggs in one basket. Diversify your portfolio and allocate only a portion of your capital to options trading. Determine your risk tolerance and stick to it. Don't chase quick profits or let emotions dictate your decisions. Another key principle is setting stop-loss orders. These are predetermined price points at which you automatically exit a trade to limit your losses. Stop-loss orders act as your safety net, preventing small losses from snowballing into major setbacks. They take the emotion out of trading, ensuring you stick to your plan even in volatile market conditions. Remember, options trading is a marathon, not a sprint. It's about making calculated decisions, managing risk effectively, and gradually growing your capital over time. Don't let greed cloud your judgment or fear paralyze your actions. Stay disciplined, stick to your plan, and always prioritize capital preservation. Section 7. Option trading strategies, a glimpse into the arsenal. The world of option trading offers a vast array of strategies, each with its own set of risks and rewards. From simple strategies like buying calls and puts to more complex strategies involving multiple options, there's a strategy for every market outlook and risk tolerance. It's like having a toolbox filled with specialized tools for different tasks. One popular strategy is the covered call. This involves selling a call option against shares of stock you already own. It's a way to generate income from your existing holdings while limiting potential upside. If the stock price stays below the strike price, you keep the premium. If the stock price rises above the strike price, your shares may be called away, but you still profit from the price appreciation. Another common strategy is the protective put. This involves buying a put option on shares of stock you own. It's like an insurance policy that protects you from potential losses. If the stock price drops, the put option gains value, offsetting your losses. If the stock price rises, you simply let the put option expire and enjoy the profits from your stock holdings. These are just two examples of the many strategies available to option traders. As you delve deeper into the world of options, you'll discover a wide range of techniques to tailor your approach to specific market conditions and risk preferences. The key is to choose strategies that align with your investment goals and understand the mechanics behind each approach. Section 8. Real-world examples, bringing option trading to life. Let's bring option trading to life with some real-world examples. Imagine you're bullish on Netflix, anticipating a surge in subscriber growth after a successful new season of Stranger Things. You could buy call options with a strike price slightly above the current market price, betting on a significant upward move. If your prediction is correct and Netflix's stock price jumps, your call options would gain value, allowing you to exercise them and buy the stock at the lower strike price. You could then sell the stock at the higher market price, pocketing the difference as profit. The leverage provided by options amplifies your gains, turning a modest price increase into a substantial return. On the other hand, let's say you're bearish on Tesla, concerned about increased competition in the electric vehicle market. You could buy put options with a strike price slightly below the current market price, anticipating a downward move. If Tesla's stock price drops, your put options would gain value, allowing you to exercise them and sell the stock at the higher strike price. You could then buy back the stock at the lower market price, pocketing the difference as profit. These examples illustrate how options can be used to capitalize on both bullish and bearish market outlooks. The key is to identify potential price movements and choose the appropriate option strategy to align with your predictions. Section 9. The importance of education and practice. Before you jump headfirst into the options market, remember that knowledge is power. Take the time to educate yourself about the intricacies of option trading. Read books, attend seminars, and explore online resources to deepen your understanding of options concepts, strategies, and risk management techniques. Practice makes perfect, especially in the world of trading. Start with a demo account where you can trade options with virtual money. This allows you to experiment with different strategies, get a feel for the market, and build confidence without risking real capital. Once you feel comfortable, you can gradually transition to a live trading account. Don't be afraid to seek guidance from experienced traders or financial advisors. They can provide valuable insights, help you refine your strategies, and navigate the complexities of the options market. Remember, trading is a continuous learning process. Stay curious, stay informed, and never stop seeking knowledge. Section 10. Conclusion. Embrace volatility, unlock potential. Options trading, often perceived as a complex and risky endeavor, can be a powerful tool for investors seeking to enhance their returns and navigate market volatility. With the right knowledge, a disciplined approach, and a solid risk management plan, you can potentially turn market fluctuations to your advantage. Remember, options are not a get-rich-quick scheme. They require careful consideration, strategic planning, and a willingness to learn and adapt. Embrace the volatility, unlock the potential, and embark on an exciting journey into the world of option trading. With dedication and a thirst for knowledge, you can master this sophisticated financial instrument and elevate your investment strategy to new heights. So, are you ready to take the plunge? The world of options awaits, offering a realm of possibilities for those who dare to explore its depths. Remember, fortune favors the bold, but it also rewards the informed and disciplined. Step into the arena, armed with knowledge and a strategic mindset, and unlock the potential that options trading has to offer.